Picture this. You're in the exam hall. You're staring down that big 16-mark consolidation question. You feel pretty good. You've practiced it. But then you make one tiny little conceptual mistake. And just like that, the whole balance sheet, it just won't tally. So what is that one mistake that can totally derail your answer? Well, we're going to find it and we're going to fix it right now. All right, let's jump straight into a classic exam scenario. H Limited buys 80% of S Limited. The examiner gives you two balance sheets, a bunch of adjustments, and you can practically hear the clock ticking. That feeling of, okay, what's my first step? Where do I even begin? That's exactly what we're here to solve, piece by piece. The key to this whole puzzle? It's Accounting Standard 21, Consolidated Financial Statements. And look, this isn't just about plugging numbers into a format. It's about learning to tell the real, complete financial story of a whole group of companies, as if they were just one single business. So first up, why bother? Why go through all this trouble? Well, the whole point of AS21 is to show the financials of a parent and its subsidiaries as if they are one single economic powerhouse. We're looking past the separate legal names to show the true assets the group controls, the debts it owes, and the profits it makes together. Now, before we even think about touching a calculator, we have to get our definitions straight. We need to know who's who and what the rules of this consolidation game actually are. This part is foundational, so let's lock it in.
First, the parent. Super simple, right? A parent is just a company that has at least one subsidiary. So, in our exam question, H Limited, the buyer, is our parent company. Easy enough.
And of course, that means a subsidiary is a company that is controlled by another company, the parent. S Limited is our subsidiary. Now, I really want you to focus on that word I just said, controlled, because that one word is the trigger for everything in AS21. So what does control actually mean? AS21 gives us a clear definition. It's the power to call the shots, to govern the financial and operating policies of another company so you can get the benefits. It's not just about owning shares. It's about having the final say on how that business runs. Now, this slide is super important, especially for your MCQs. How do we know if control exists? Well, there are two main ways. The obvious one is owning more than 50% of the voting power. But here's the other one. Even if you own less, if you control who sits on the board of directors, that's also considered control. If you meet either one of these, you have to think about AS21. Okay, and here we go. This is a classic ICI trap, and you do not want to lose easy marks here. Listen carefully. AS21 does not say every parent company must prepare Consolidated Financial Statements, or CFS, but, and this is the big but, if a company decides to prepare them, or another law says they have to, then they must follow AS21. It's about the how, not the if. That's a critical distinction. All right, let's get into the numbers. Our very first working note, the one you'll do 9 times out of 10, is calculating the cost of control. This whole calculation is designed to give us one of two things, either goodwill or its opposite, a capital reserve. The main idea here is something called elimination. See, in the parent's books, there's an asset called investment in subsidiary, and in the subsidiary's books, there's share capital and reserves. If we just add them up, we're double counting, so we have to cancel out the parent's investment against the slice of the company it actually bought. That's the whole point of this calculation. Look how simple this is. Let's say the parent paid $1,200 for its share, but the book value of the net assets it got was only $1,000. Why would it pay extra? Well, that extra $200 is goodwill. It's for the brand, the reputation, something intangible. Now, what if it had paid only $900? Well, that would be a bargain, and that $100 difference would be a capital reserve. Okay, first working note done. Let's move on to the second big one, calculating minority interest. Remember, H Limited only bought 80% of S Limited. So what about that other 20%? Well, that belongs to other shareholders, the minority, and we have to figure out what their share is worth. This chart shows it perfectly. That big 80% chunk belongs to the parent. But that smaller 20% piece, that's the minority interest. These are the other owners, and we need to show their claim on the business separately in our consolidated balance sheet. So the textbook definition is pretty straightforward. Minority interest is the part of the subsidiary's net assets that belongs to those outside shareholders. It's their slice of the pie. And how do you calculate it? It's a simple 3-step recipe. First, take their percentage of the share capital. Easy. Then, add their share of all the profits and reserves that were there before the takeover. And finally, add their share of all the profits earned since the takeover. That's it. Okay, everyone, deep breath. This is it. This is the 16-mark mistake I mentioned right at the start. This is where people lose a ton of marks. You have to split the subsidiary's profits into two buckets, pre-acquisition and post-acquisition. The parent share of the pre-acquisition profits, that's a capital profit. It reduces the cost of your investment so it gets adjusted against goodwill. But the parent share of post-acquisition profits, that's a revenue profit. That gets added to the group's own reserves. If you mix these two up, your balance sheet will never ever tally. This is the most crucial point. All right, we've calculated our goodwill. We've calculated our minority interest. The final big step is a bit of housekeeping. We need to make some adjustments to cancel out any transactions that happened inside the group, between the parent and the subsidiary. Think of this as your final exam checklist. We've done the big adjustments like goodwill and minority interest. Now we have to do these intragroup eliminations. We're talking about things like mutual debts or unrealized profits on stock. We have to get rid of these so the final accounts only show transactions with the outside world. Let's take the easiest example, a loan between the two companies. H Limited's books say S Limited owes it $50,000. S Limited's books say it owes H Limited $50,000. When we put them together as one big company, can a company own money to itself? No, of course not. It's like moving money from your left pocket to your right pocket. So in the consolidated accounts, both that debtor and that creditor just disappear. We cancel them out. And here's a little exam tip. This comes right out of the standard. What if you buy a company on, say, August 10th? It's pretty much impossible to prepare a full balance sheet on that exact date. So AS21 gives you a practical solution. It says if it's not practical, you can use the subsidiary's financial statements from the last closing date as your starting point. It's a small point, but it could be a tricky adjustment in the exam. And finally, it is so important to know the boundaries here. AS21 is only for parent-subsidiary relationships where there's control. It has nothing to do with amalgamations. That's a whole different world covered by AS14. And it doesn't apply to associates or joint ventures where you just have influence, not control. That's AS13. Knowing what not to do is just as important. Picture this. So you're in the exam hall. The clock's ticking. You see this question. You paid 70 lakhs for a 70% stake. Simple enough, right? Your cost of investment must be 70 lakhs. It's the obvious answer, or is it? Wrong. And boom, just like that, you've walked right into the trap ICI set for you. This is exactly where easy marks are lost. The real cost of investment is almost never that simple. And today, we're going to pull back the curtain and show you exactly how to find it. All right, first step, the real cost of investment. Look, this is ground zero for every single consolidation question. If you mess this part up, your balance sheet will never tally. It all boils down to one simple idea, comparing what you paid with what you actually got. And we're going to use this exact four-step formula every single time. Seriously, memorize this. It's your key to solving any goodwill or capital reserve problem. We'll walk through it using illustration 3 from the ICAI material so you can see it in action. Step 1, let's go. Okay, step 1 is all about calculating the net assets of the subsidiary. And here's the first place people go wrong. See that revaluation column? You can't just use the book value. That's a classic mistake. You have to use the fair value on the date you bought the company. So we adjust the PPE up, the investments down, subtract the liabilities, and bam, we get the real net assets, 138.5 lakhs. Step 2? Super easy. We just take that 138.5 lakhs in net assets and multiply it by our 70% stake. That gives us 96.95 lakhs. So this is the value of what we got. Now let's figure out what we actually paid. And here we go. This is the big ICI twist, the pre-acquisition dividend. This is probably one of the most common places where students lose marks, so listen up. If a subsidiary pays a dividend from profits it earned before you came along, it totally changes the game for your cost calculation. So let's get this crystal clear. AS21 says a pre-acquisition dividend is not income. Think of it like this. It's a refund. You're getting back a piece of the money you just paid. It's not a return on your investment, it's a return of your investment. And what do you do with a refund? You subtract it from the original price. So back to our example. We thought we paid 70 lakhs, right? But then we got that 7 lakh dividend from pre-acquisition profits, so we have to subtract it. And there it is. Our true cost of investment is only 63 lakhs. That's the number we need. Step 3, done.
All right, step 4, the final showdown. It's simple. What we got versus what we paid. We got 96.95 lakhs worth of net assets, and we paid, after that dividend adjustment, only 63 lakhs. So think about it. We got way more than we paid for. That's a great deal, a bargain purchase. And since this is a capital gain, not an operating profit, that difference of 33.95 lakhs goes straight to capital reserve. Now, if it was the other way around, if we had paid more than what we got, that extra amount would have been goodwill. Simple as that. All right, we've nailed goodwill. Now let's talk about the other side of the coin, minority interest. I mean, if we own 70%, someone else owns the other 30, right? We need to figure out their share. Sounds easy, but it gets really tricky when the subsidiary starts losing money.
So here's a great exam level question for you. What happens if the subsidiary is just bleeding cash? Year after year, massive losses. The minority's share of those losses could easily be more than their entire investment. So can minority interest actually go negative? What do you think? And here's the rule, straight from the standard. You can only push minority interest into the negative if, and only if, the minority shareholders are legally on the hook to cover those losses. But let's be real, in 99% of your exam questions, there's no such obligation. So the rule is simple. Their losses are capped at 0. They can't lose more than they put in. This table shows it perfectly. Just look at year 3. The minority's share of the loss is $150,000, but they only have $129,000 left in their account. So what do? We cap it. They only absorb $129,000, bringing their interest down to a big fat 0. The rest of that loss? Well, that's on us, the parent company. Then in year 4, more losses, but their interest is already 0, so they absorb nothing. And then, check out year 5. A profit is made, and that profit first goes to rebuilding the minority's interest. Next up, intra-group deals. Now, the whole point of consolidation is that we pretend the parent and subsidiary are one giant company. And you can't make a profit by selling something from your left pocket to your right pocket, right? So any profit from these internal sales has to be canceled out until the goods are sold to someone outside the group. Okay, now this is a big one. Seriously, star this, highlight it. This is where so many marks are won or lost. It's not just about finding the unrealized profit. You absolutely have to know who sold the goods. Was it the parent or the subsidiary? Because the adjustment is totally different depending on the answer. Let's break it down. Downstream, think of it as profit flowing down from the parent to the sub. Since the parent made 100% of that profit, the minority isn't involved at all, so the adjustment only hits our consolidated profit. Easy. But upstream is different. The profit is flowing up from the sub to the parent. Because that profit was made by the subsidiary, the minority shareholders own a piece of it. So we have to split the adjustment and reduce both the consolidated profit and the minority interest. Okay, let's see an upstream example in action. Subsidiary B sells to parent A. There's 50 lakhs of unrealized profit sitting in the inventory. We, parent A, own 75%. That means the minority interest is 25%. Got it? Let's see how we split this profit. So that 50 lakh profit, we can't just wipe it all from our books. Because it was an upstream sale, the subsidiary made the profit, we have to split it. Our share, 75%, which is 37.5 lakhs, comes out of the consolidated P&L. The other 25%, which is 12.5 lakhs, has to come out of the minority interest. See how that works? If it had been downstream, the whole 50 lakhs would have just hit the consolidated P&L. This distinction is crucial. All right, we're on the home stretch now. This last point is more of a housekeeping rule, but it's an easy mark in the exam, so don't ignore it. It's all about making sure our reporting dates are aligned. Ideally, the parent and the sub should close their books on the same day. But, life happens. AS21 gives us some wiggle room. But there are rules. First, the difference in dates can't be more than 6 months. Second, you have to adjust for any big significant events that happen in that gap. And third, whatever gap you choose, you gotta stick with it. Consistency is key. So, let's zoom out for a second. Goodwill, minority interest, unrealized profits, all these adjustments. What's the point? It all comes down to one single idea: presenting the parent and its subsidiaries as a single economic entity. We're trying to create one unified financial picture that shows the true scale of the entire operation.
Okay, so picture this. You're in the exam. You're tackling a consolidation question, and you're feeling good. You've gone through, you've canceled out all the intercompany sales, all the services, everything. But then you see a little note at the bottom of the question about stock. What do you do with that? And right there, That's it. That's one of the most classic traps that IKI loves to set. It's the kind of small detail where so many easy marks are just gone. Today, we're going to make absolutely sure you never fall for it. To really get this down, we're going to work through a practical problem, illustration 15 from your material. Think of this as your exam question for right now. We've got H Limited, the holding company, and S Limited, the subsidiary, and a whole bunch of transactions between them. This is exactly the kind of setup you're going to see on exam day.
All right, let's jump into Section 1, Building the Consolidated Profit and Loss Statement. We're going to use our illustration to see exactly how this is done in practice.
You know, the main idea behind a consolidated P&L is actually really simple. You literally take the P&L of the parent, take the P&L of the subsidiary, and just add them up, line by line. H's sales plus S's sales. H's expenses plus S's expenses. And why do we do this? Well, the whole point is to show the entire group as if it was just one single giant company. Okay, first big step, and this is super important. Once you've added everything up, you have to get rid of any transactions that happened inside the group. I mean, think about it. If H sells something to S, is that really a sale from the group's perspective? No way. It's like moving money from your left pocket to your right pocket. So we've got to find all of them. H's sale to S, the consultancy fees, the commission, all of it has to be completely removed from our total. So let's see how that works with our numbers. We start with the combined revenue of 6,000 lakhs. Then we subtract the 120 for the intercompany sale. We take out the 5 for consultancy fees, and we remove the 10 for commission. What we're left with is 5,865 lakhs. That's the real consolidated revenue, the money the group actually earned from the outside world. So we've eliminated the transactions. Job done, right? Well, not so fast. Let's get back to that trap I mentioned right at the beginning. What do we do about the profit on goods that were sold internally but are still just sitting in the warehouse at the end of the year? And here's that ICII twist. This concept is so important. A profit is only a real profit for the group when the goods are sold to an external customer. If H Limited sells to S Limited and makes a profit, but S Limited hasn't sold those goods yet, that profit hasn't really been earned by the group. It's an unrealized profit, and it absolutely must be eliminated. This is a huge reason why marks are lost. So how do we actually calculate this thing? Well, the problem says H Limited sells goods at cost plus 20%. Let's break that down. That means for every 100 of cost, they add 20 of profit. So the selling price is 120. That means the profit margin times on the selling price is 20 divided by 120. Simple, right? So we just apply that ratio to the value of the goods still in S Limited stock, which is 24 lakhs. So 24 times 20 divided by 120 gives us 4 lakhs. And that right there is our unrealized profit. Now listen up, because this is the really crucial part. Where does this 4 lakhs go? It has a double impact. First, you reduce the value of the closing stock on the balance sheet, which reduces the increase in inventory line in the P&L. And second, you reduce the consolidated profit directly. You have to remember this double entry effect. It's absolutely non-negotiable if you want to get the right answer. Okay, let's switch gears. We're moving on to Section 2. We're going to step back from the calculations for a minute and cover some essential theory, the kind of stuff you just can't afford to get wrong in the exam. First up, the Consolidated Cash Flow Statement. The rule here is pretty straightforward. If the parent company has to prepare its own CFS, then the group has to prepare a consolidated one too. And the method is exactly the same as the P&L. You add everything up line by line, and then, you guessed it, you eliminate all the cash that move between the parent and subsidiary, like loans or dividends.
Now this next one, this is a big deal. Para 20 of AS21 is non-negotiable. You absolutely must use the same accounting policies for the whole group. You can't have the parent using FIFO for inventory and the subsidiary using weighted average. The entire group needs to speak the same accounting language. It has to be uniform, period.
So what happens if there is a mismatch? Let's look at a classic example. Let's say the subsidiary uses weighted average for its inventory, but the holding company uses FIFO. What do? Well, you have to fix it. You have to go back to the subsidiary's books and restate their financials, recalculating their inventory and cost of goods sold as if they'd been using FIFO all along. Only after you've made that adjustment can you even start consolidating. Okay, Section 3. Now we're getting into the real heavy hitters of the consolidated balance sheet. These are the two calculations that can literally make or break your score: goodwill and minority interest. Let's start with goodwill. The logic behind it is actually pretty simple when you think about it. First, you look at what the parent company paid to buy the subsidiary. That's your cost of investment. Then you look at the actual value of the share in the subsidiary's net assets that the parent got. You compare those two numbers. If you paid more than what you got, that extra amount is goodwill. If you got a great deal and paid less, that's a bargain, and it creates a capital reserve.
All right, next up, minority interest. So if the parent company owns, let's say, 80% of the subsidiary, what about that other 20%? Well, that's owned by other shareholders, by outsiders. Minority interest is basically their claim on the subsidiary's net assets. And it's really important to remember, on the consolidated balance sheet, this is shown as its own separate item, not mixed in with the parent's equity.
Now you have to watch out for this one, because ICI absolutely loves to test the details here. There's a huge difference between calculating minority interest on the day you buy the company versus on the day you're preparing the balance sheet. At the start, it's just their percentage of the share capital and whatever profits existed before you bought them. But later on, you have to include their share of all the profits made since you bought them too. You've got to update it.
Let's level up. Section 4 is all about those more complex adjustments, the kind that ICAI loves to throw in to really separate the students who know their stuff.
Here's a tricky one for you. Think about this. S Limited pays a dividend. H Limited, the parent company, gets its share and, naturally, books it as income in its P&L. Seems simple, seems right. But what if that dividend was paid out of profits the subsidiary had earned before H Limited even bought it?
And this is where the logic flips. A dividend paid from pre-acquisition profits is not income. You have to think of it as getting some of your money back, a recovery of the price you originally paid for the investment. So the correct entry is to reverse that income out of the P&L and instead credit your investment account, reducing how much it's worth on your books. This adjustment is so critical. And here's another quick but vital point you can't afford to miss. Let's say the subsidiary's assets were revalued when they were acquired. You have to be so careful here. From that point on, the consolidated depreciation has to be calculated on the new, revalued amount, not the old one. So many students forget this step, and boom, marks are gone.
All right, we're on the home stretch now. Section 5. This is your final rapid-fire checklist. These are the absolute non-negotiable rules you need to have locked in your brain before you walk into that exam. First off, what even is total share capital? When you're figuring out who has control, it's not just the equity shares. You have to include paid-up equity capital plus any convertible preference share capital. That detail matters.
Next, a simple number to remember, 6. What's that? It's the maximum number of months allowed between the reporting dates of the parent and the subsidiary. You can't consolidate financial statements that are more than 6 months apart.
And to wrap it all up, let's go over the golden rules. If you remember nothing else, remember these 4 things. 1. Always separate pre-acquisition capital profits from post-acquisition revenue profits. 2. Eliminate 100% of intercompany transactions. 3. Eliminate 100% of unrealized profit in stock, even if you only own 80%. You eliminate the whole thing. And 4. Be absolutely meticulous with your goodwill and minority interest calculations.